To start this video, I want to play this clip on DIVO, which I think is the single best competitor to SCHD.
To think about it kind of the way I think about it, which is if markets are rising, we want to participate in that rising market from a total return. And maybe we're not going to exceed it because we're having covered calls as a component in the portfolio. But if we can capture 80 to 90% of that upside, well, that's a win. And we certainly did that in the first quarter. More importantly to us, if markets are declining, we want to limit that downside capture, that downside exposure. If we can be participants in only 65 to 75% of that down market, then that's really important to us. And then regardless of what markets are doing, up, down, or sideways, if we can drive that cash flow component to between that 5 to 7% target, then we feel like we really have that core equity income strategy that allows clients and advisors to take an income stream with confidence and also to expect an increasing cash flow over time as a result of that dividend growth component that's so important in every stock that we own.
All right, so the first thing is a disclaimer. You're looking at my portfolio, at least the dividend side of my portfolio, and we can see that I currently hold SCHD. DIVO is very interesting. I do not currently hold it, but I've been doing lots of research into it because I think it might be better or at least comparable to SCHD, and that's what I want to lay out in this video. As you can tell, I'm not 100% set in stone. This is not an exact science, so this is an open discussion, and please leave your thoughts in the comments below. I also want to mention that I'm not going to take a deep dive into both of the ETFs, like their holdings, methodology, because I've done that all before on the channel and other videos, so I'll leave one linked at the top right. Okay, so you're looking at the total return chart past 5 years, DIVO in blue, SCHD in green. And clearly, the green line is mostly above the blue line. So clearly, SCHD is better. We can also come over to the 1-year chart, and once again, we see green over blue. Now, there is a couple things that I want to point out, and I want to draw your attention to the past year of SCHD. Look how almost vertical this price appreciation line is. For you new investors, this is not normal or sustainable. This was an amazing past year. Nobody could take that away from SCHD, but don't expect 2021 and 2022 to just continue to go straight up and to the right. It's most likely going to cool off because right now, SCHD is very expensive. If we look back in time over the past 5 years, we can see the gains were much more modest, very respectable, but just not as insane as they were in the past year. So you just have to keep that in mind when looking at the charts. Another piece of data with SCHD is the rate of the dividend growth. So that's being represented right here, the year-over-year change in the dividend. And the past 2 years have been incredibly high. And just like with the price appreciation, I would not expect this to continue. It's just not sustainable. My guess is that 2021, 2022, the dividend growth rate is going to be more between like 4 and 8%, which is still great, but just don't get used to these kinds of numbers. They're just not sustainable. So with all that in mind, let's compare DIVO versus other very popular dividend ETFs that also perform very well, just not the absolute best. So VOIM, extremely popular, and we can see how it compares versus DIVO. And we can see these charts are much more in line with each other, and as of late, DIVO has actually been doing slightly better. Another one we can toss in that's very popular is Noble. If we toss in this line, we can see how they compare. We can also change the time frame to the 1 year, and we can see that all these ETFs are much more realistic and in line with each other. Now, moving beyond the graphs and the hard numbers, I want to talk about the conceptual layout of all these ETFs and kind of what role they play. So I kind of have like a ranking system here, and we can see that at the top is like the softest ETF. So this is VIG, it's a dividend growth ETF. The yield is 1.5%. Next is DGRO. This has been doing slightly better, 2% yield. Moving down, we have Noble, VYM, and then SCHD is the best of class dividend ETF. Now, the story doesn't stop there because ETFs come in many different shapes and sizes, and we can continue. There is a hard divide here because above this imaginary line are just the pure dividend ETFs, and below this invisible line, they introduce some kind of new strategy to have better performance. And the first one, the softest one once again, is DIVO. And then if you want to continue down the rabbit hole, you have JETB with a dividend yield of around 8% right now, XYLD, QYLD, NUSI, so on and so on. But DIVO is definitely the lightest buy right ETF. They focus primarily on just having dividend companies in the portfolio with some opportunistic covered call writing on top of it to try to generate a slightly higher yield. But it's mostly dividend companies. I said I wasn't going to dive deep into the fact sheets, but you're looking at DIVO right now, and this is the selection methodology. And you can see it's primarily just made up of dividend stocks with just some covered call writing on top of it. And here's a little breakdown of the income potential. So just speaking conceptually, I hope you guys can understand why I think DIVO and SCHD are a great comparison and very similar in a way, because SCHD is the best pure dividend ETF, and DIVO is kind of the next step up with being still mostly dividend companies with a little bit of extra spice on top. And when it comes to the overall performance, once again, SCHD has had a phenomenal 2020, so you got to keep that in mind when comparing the performance. As you can see here, DIVO is much more in line with the other very popular dividend ETFs. There's not much of a difference. The major difference is simply the way that this ETF delivers you the total return. More of it is captured in cash flow, the dividend yield, almost 5% right now, versus in capital appreciation. So you kind of see how that balancing act works. And compared to SCHD, DIVO takes some of the returns from capital gains and gives them to you as a distribution. So as dividend investors, DIVO might be more attractive because of that. But like I said, this is an open discussion, so please leave your thoughts and opinions in the comments down below. I hope you guys enjoyed the video. If you did, leave a like before you go, and I'll see you next time.